want to welcome you to our call today with Harold Gatlin, CPA, President of the Gatlin CPA Group. The title of our call today is Tax and Accounting Strategies for Businesses here in 2014. And before we get started, there are just a couple of housekeeping issues that we want to cover. If you've dialed in on the phone line today, we will have the lines muted during the call just to prevent any background noise. But if you do have a question as Harold discusses each topic, just press star 2. That's star 2, and that will raise your hand, so to speak, so that we know you have a question and so that you can ask that. If you are listening via the internet on the webcast, there is a box towards the bottom of the page titled Submit Your Question for the event here. If you have a question, just type in that question right there in the box, click the Submit button, and we'll check those messages at the end of the call and get Harold to answer those too. So again, we want to welcome you to our call today with Harold Gatlin, CPA, President of Gatlin CPA Group. And again, the title of the call is Tax and Accounting Strategies for Businesses here in 2014. If you are not already a client of Harold's, he's a licensed CPA in Indiana and Illinois. Harold earned a bachelor's degree in accounting from Marshall University and has a master's degree in education. He is a member of the American Institute of Certified Public Accountants and the Indiana CPA Society. Harold is president of the Gatlin CPA Group, which has offices in Plymouth, Valparaiso, and Maryville, and services individual and business clients in the northern Indiana and South Chicago region. So we'll get started. Harold, welcome to the call.
Nice to be here, Jeff.
Well, we've got a full range of topics today. We've got a lot of people on the call and on the webcast. I'll go ahead and just let you get started.
Okay, that's fine. Today we're going to talk about, we're right at the beginning of the so-called tax season, as you know, and everybody we deal with, businesses and individuals, are actively involved in getting their finality of their 2013 year information to us. Not just to us, we're trying to get through the tax returns, and we've actually, when we do this, something like this, we start the process for businesses back about the middle of November, and we do tax planning toward the end of the year. So this is sort of a culmination of that planning process, actually the easier process. It's more time demanding, but the critical decisions are made at that time. We want to talk about a few subjects this morning. In this brief period of time, I want to talk about some of the changes in the federal tax rates between 12 and 13 and going forward. I'll briefly touch on home office deduction changes, long-term capital gains, this new Medicare tax, which you may be very interested in, and also some sales tax collection. Those that's online requirement right now. These are items that I have down here, and I'm open to some other items as well. Actually, I have some others in my mind if we have time to cover. There's a multitude of areas that can be dealt with, but for the sake of brevity, we'll try to limit that here. As you may know, when we talk about the top federal tax rates, there has been a new rate added for the 2013 year, and that's a 39.6% tax rate. And that's for taxable income over $450,000. So you may right off the bat dismiss that if you're under that. Most of the other tax rates, they start at 10, 15, 25, 28, 33, and 35%. And that's what those same tax rates for what's been here in the past. We simply added the 39.6%. And so that's sort of the approach, what we've seen with the current situation in Washington, where they're trying to deal with those that are stronger, or what they refer to as the top level of income earners, and so they're going to affect that in a more dramatic way than every other tax bracket. Each one of those will go up nominally. Okay, the Social Security rate is going up in 2014. Not rate, but the level will go up to $115,500. That's up almost a couple of $1,000. So there's an increase there. And of course the corresponding increase in the FICA tax. One of the big things here in where we work in Indiana is we have a lot of clients in Lake County, effective October 1st of 2013. Lake County was the only remaining county in the state of Indiana that still did not have a county income tax. And at that time, they adopted a 1.5% income tax, along with the state tax rate of 3.4%. So for them, the effective rate is 4.9% or almost 5%. Now, we have some of our clients that may be listening are in the southern suburbs of Illinois, and of course, their sales tax at this point is 5%, or their income tax is 5%. So in some of the counties in Indiana, they may approach that 5%, like Lake County. Some of the others, we have offices in Porter County and Lake County and also in Marshall County, and all three of them have a different rate. So depending on where you are is going to determine what that rate is, and some of the counties have substantial rates. So where this rate situation goes, the federal tax rates from there for 14, we don't know if there'll be nominal increases. That's all we see on the horizon right now. There is some significant tax reform that is being considered. Do I think that it'll get through? We really don't think that we're going to see anything this year as far as a major tax bill going through. There's certainly consideration. Max Baucus is head of that tax reform thing, and he's stepping down, so there's going to be a changing of the guard there, and that takes time to get familiarized with the new players involved. And so, but we should be able to see something, whether we like it or not, in the next couple of years. The last significant Tax Reform Act in this country was in 1986, and that tells you how long it's been since there's been significant tax reform. Moving on to the next topic here, we have briefly touch on the home office deduction changes. We have in our firm quite a few CPAs, and we have one reason or another the occasional audits with the IRS here. We just finished an audit yesterday for a client, a business client, and one of the discussions was on the home office deduction. And I think that basically the easiest way to consider that is that the square footage of your facility, of your house, and that particular room that's completely dedicated to the endeavor at hand, that percentage, if you have a 200 square foot office and you have a 3,000 square foot home, then that fraction can be applied to the indirect expenses. We can get into more detail on that later. Certainly the things that are directly related, the carpet for that room, the computers for that room, and so forth are expenses. Let's talk about the long-term capital gains increase, the tax increase, and that's significant because we saw the market go down in January here if you have investable assets. And what's taken place is that, I'm going to go back and just stay with me on this analysis right now. From 2012, the maximum capital tax gains, long-term capital gains tax rate was 15%. In 2013, what happened, of course, is that went up to 20%. And there was also the potential of the surtax on net investment income of 3.8%. So you're going from 15% in some cases up to almost 24% for long-term capital gains tax rates. Now, what it looks like took place was a lot of investors back in 2012. What they did was they cashed out, paid taxes on their capital gains at the old tax rate of 15%, and then probably jumped back in the market, it looks like, in January of 13. That way, they've got their paying tax at the old rate, and they felt like that's the last time they can do that. So now they're jumping in 2013, and we all know what happened in 2013. The market did incredibly well, and so a lot of, especially the high-end investors, they didn't want to pay ordinary income tax rates because they would have been, of course, at nearly 40%. So even that 24% looked good to them. So they saved in order to make that a long-term capital gain. In which case, we see that in January 14, probably quite a few of those have dumped their stocks to take long-term capital gain tax treatment, and in so doing, drove the market down. That's one impact of the market, among others. So, and then we like to think that, and of course we've seen over the last few days, of course, some improvement in the market because we're past that. We like to think past the bulk of that. But that additional Medicare tax, we know that the long-term capital gains tax rate is now at 20%. And if you have, your adjusted gross income is $250,000 or higher, and you're married and filing jointly, then you're going to have a 3.8% surtax on the lesser of the net investment income with what is called a modified adjusted gross income. And we can get into detail with your individual situation if necessary to determine what that is. There is also an additional tax in 2013, almost 1%, 0.9%. So Medicare tax on earned income if you're married jointly and you have over $250,000. So that's an extra almost 1% on that to cover the Affordable Care Act. So we see a few things that are coming onto the horizon that we've not seen before, most of which have to do with Medicare, Medicaid, and the Affordable Care Act. Let's go ahead here for a minute. We talked about the capital gains tax and also the new Medicare tax on investment income. One thing, as we're talking about taxes here, the sales tax collection in the state of Indiana, not Illinois, but in Indiana, effective at the beginning of 2013, all sales tax collection was required to be filed online. We're filing that online for a lot of our business, for most of our business clients. There's actually a few that have not followed through to file online. We find the Indiana Department of Revenue is still accepting the manual filings, but it is more cumbersome that way, and it's making it increasingly difficult to file that way. So if you're in that situation, it's time to move to the online sales tax collection and remittance to the government, or the state government. Now, I'll mention a couple other things here that I want to get into. Those are just briefly talking about discussing those individual topics. One of the questions that we get here just recently, a couple things, is because of the increase in the market in 2013 and the value of investments and stocks increasing substantially, one way to save on your taxes, of course, is to make charitable donations of appreciated assets, particularly in stocks. This is the way you escape the capital gains tax, and you get a deduction for the full value of that stock for your donation. That is, as long as you've had that for a year. You don't want to donate it if it's falling in value, because you waste your capital loss in that case. And this is reduced if you have adjusted gross income over $250,000 for singles and for $300,000 for marrieds. So that's one way to deal with the growth in the stocks for last year, if you're ready to deal with that. If after listening to this call today you have any questions about any of these business, accounting, or tax issues, feel free to give us a call. Usually what we do when we're fortunate in that when businesses come to us, I like to say that they're satisfied and they stay with us for a long time. Only you can get that same satisfaction, but we offer a complimentary consultation if you have any particular question that maybe is not appropriate for the phone call we have right now, or a situation that you really don't want to ask or discuss on a call like this. I can provide an opportunity to deal in the confidentiality of our office, one of our offices here, or for that matter, give you a second opinion on something that you previously received. Jeff, I don't think I have any other particular, I'm touching on things here, and the gentleman here this morning doing some significant information on some of the tax rates and some of these topics, particularly in the long-term capital gains. But I'll leave that with you.
Sure, Harold. Let me go ahead and check. We'll open up the phone line. So again, if you're listening on the call and you have a question, you can just go ahead and ask Harold your question. Let me check also on the webcast, see if we've got any questions come through. And I don't see any. And again, anybody on the call, if you have a question, just go ahead and speak up. A lot of times when we don't have any questions, Harold, it usually means that you've covered everything. Or in this case, given the weather today here in Indiana, everybody could be frozen. I think it was negative 14 degrees where I'm at this morning when I woke up.
Very cold.
Very cold. And I don't see any questions, so I think we're good.
That's good. I would say that some of the other topics that come in here today we're getting are things like on the Affordable Care Act and that sort of thing, but that's a subject of its own that needs a separate discussion on. That, along with some of these other charitable kind of issues or Section 179, that sort of thing, we can deal with it another time.
Okay, great. Well, again, if you're listening on the replay, potentially, because we are recording the call, and you have a question after the fact and you want to get a hold of Harold, there are two good ways to get a hold of him. One is calling the Plymouth office, and the phone number there is 574-936-5211. It's 574-936-5211. Or in the Valparaiso office, the number there is 219-462-7544. Again, that's 219-462-7544. Or you can always send Harold an email at hgatlin@gatlincpa.com. And again, we want to thank everybody for being on the call today and listening in with Harold Gatlin, CPA, President of Gatlin CPA Group. And our call today was titled Tax and Accounting Strategies for Businesses in 2014. And also, again, if you're listening on the replay and you do have a question, feel free to give Harold a call or send him an email at the different numbers that we gave. Harold, thanks again for taking time out this morning. Stay warm up there, and we'll talk to you soon.
Thank you much. Bye now.